Well, good morning, everyone. My name is Sandy Horner. I'm going to be one of your hosts today. I just wanted to introduce myself and let you know that I put a Social Security quiz up on the screen to get the mind flowing with regard to Social Security. This is a true false quiz. It's meant to be fun, not graded. We'll get started literally in about a minute. But I just thought this might be interesting for you to have a look at. And I'll give you the answers in a moment. I can see people are getting logged in, so we'll give folks a minute or two to kind of get situated before we get underway here, and then we'll get formally started. But for now, feel free to peruse the Social Security quiz. Answers forthcoming momentarily. All right, so if you're wondering about the answers, here they are. Give you a second to look at that, and that'll give folks, or excuse me, I'll give you a minute to look at that or thereabouts. That'll give people another minute to get logged in, and then we'll get underway today. So hopefully you were intrigued at a couple of those answers, and we're going to be talking about all of those topics and much, much more today during our conversation about Social Security, timing and selection. Again, good morning, afternoon, as the case may be now. My name is Sandy Horner. I am with Baltimore-Washington Financial Advisors. I'm also joined today by my colleague, Senior Financial Planner Thad Ismart. He'll be joining in the presentation a little bit later. And on behalf of all of us at Baltimore-Washington Financial Advisors and the partnership that we enjoy with the Johns Hopkins Federal Credit Union, I'd like to welcome you all here today for our conversation about Social Security. So we're going to spend about an hour today. I know we technically have till 1:15. I think we will work to conclude by 1 o'clock. I personally find about an hour on Zoom is good. More is not so good. So we'll try to keep it to an hour. Going to strongly encourage you to help us make this time together interactive by utilizing the chat or the Q&A functions of Zoom. And you can ask your questions, share your comments through either of those functionalities, and we will do our best to answer all of your questions. I will suggest to you that if you ask me a question that I know is coming up in the presentation, I may not answer it right away. Fear not. Again, we will do everything we can to answer all of your questions before we part company today. I would really appreciate if you would allow me just for a minute or two to more formally introduce BWFA, or Baltimore-Washington Financial Advisors. We are a fiduciary standard registered investment advisor that works with all of our clients in a fee-only setting. This is a large part of what prompted the Johns Hopkins Federal Credit Union to inquire about a partnership with us many, many years ago now. Simply put, as a fiduciary, we are always putting our clients' best interests first. And if you're not familiar with that relationship that you have with a financial professional, the majority of the time, most financial professionals out there are not fiduciaries. So if you're working with other firms, there's a strong likelihood that you don't have a fiduciary relationship. And simply put, that means that the person that you're entrusting your wealth management to is not obligated legally or in any other way to put your best interest first. At BWFA, we very much are. We offer truly comprehensive wealth management, a lot of transparency, a lot of communication, a lot of education. We work with people with investments and planning and taxes and trust services and estate planning. And we work with business owners. And that's the BWFA building you see on the slide in front of you, right off of Route 29 in Columbia. So if you're ever out this way, stop by. We would relish the opportunity to chat with you about what it is you're trying to accomplish and how we might be able to help you. We've been ranked both nationally and locally as some of the best financial advisors in the country, the best financial advisor in Howard County. And again, we offer complimentary, no obligation conversations to learn a little bit more about each other. So if that's something that we could be of help with you, I hope that you will let us know. We are bwfa.com, and you should be able to also find our resources on the Johns Hopkins Federal Credit Union website, as we are listed there as well. So let's start our conversation. And by the way, a friendly reminder, this is the interactive part. So this is a question: who is Ida Mae Fuller? I would greatly appreciate your audience participation. And there are many of you here today. So hopefully somebody would like to take a stab at that question. Who is Ida Mae Fuller? When we get the answer, or when we get some guesses, you can send it to me in the chat. You can send it to me in the Q&A box. We'll move on and I'll answer the question. But I'd appreciate it if somebody would take a stab at answering that question. Who is Ida Mae Fuller? I often get, isn't that the character from the movie Ghost with Patrick Swayze? No, that is Ida Mae, but Ida Mae Fuller is a different Ida Mae. And Carolyn answers the question correctly. Not only the first woman who received a Social Security check, but she's the first person, the very first recipient ever of a Social Security check. And why are we talking about Ida Mae Fuller? Well, because invariably one of you will ask the question that is something to the extent of, well, isn't Social Security really going bankrupt? And so I probably won't even get it by the time I claim it, or I should claim it now so I can get something before it disappears. And so I just want to talk to you about what Social Security is, what it is not intended to be, but has morphed into, and what changes you might expect to see depending on your age. So let's talk a little bit about Ida Mae. So she was born in 1874. And as you can see, she passed away in 1975. So quick math tells me she lived to be over 100 years old. She received her very first Social Security check in January of 1940. And as you might expect, her life expectancy was not to be over 100 years old when she started collecting her check in 1940. As you could imagine, she surpassed her life expectancy by probably more than 20 years at that point in time. And so I think she's a great example of some of the frailties of Social Security. The other thing is, you can see if you've read through this slide, her first check, the very first check she ever got, was $22.54, which was that was her first check ever. And that was only slightly less than her lifetime payments in Social Security taxes, which was around $25, $24.75. And then you can see furthermore that Ida Mae Fuller received lifetime benefit payments of almost $23,000, while she paid less than $25 of Social Security taxes. So you could really say from the very first recipient, Social Security was to some extent doomed. So why is it that I'm relatively confident you will receive Social Security benefits? I'm not going to get into a big explanation about how Social Security works. Some of it is paid for by a trust fund. Some of it is paid for by current tax revenue. But what I will say to you is this: it was designed to keep the most destitute in our country out of poverty, off the street, quite literally. It was never designed to be a supplemental retirement income stream, which is what most people use it for now. And so you need to keep that in context when you think about Social Security. Also, if you have a child or grandchild born today, they are currently set up to receive the exact same benefit as me, or even somebody older than me. And so if you think about that, how could that possibly make sense? The life expectancy and work habits and longevity of somebody in the workforce born today is obviously going to be different than me and probably you. And so if you are close, if you're in your 50s or 60s or maybe even 40s, I think there's a pretty good chance you're not going to see a huge shift in your Social Security benefit. However, I think if you are younger, especially if you're not of voting age yet, if you get my drift, there's a very strong likelihood that you will see some change in your benefit, whether it starts later or is a little bit less or has some different calculation or some other aspect. Maybe your full retirement age gets pushed out another year. I don't know what the changes are. I don't have a crystal ball. But if we look back over the last 20, 30 years, we have seen slight changes like that to Social Security to help Social Security be more long-lasting for all. So keep all of that in mind when you think about Social Security. Also, very important that you keep in mind that while you're thinking about Social Security, it's not the most important question you need to be asking about retirement. The three most important questions are: where will you retire? What will you be doing? And who will you be near? Much more important than how do I roll over my 403B? Or when should I claim Social Security? Or do I need long-term care? Now, let's be upfront. Those are all important questions, and you should know the answers to them. But the most important question about your retirement is: where do you want to live? What do you want to be doing? And who do you want to be doing it with? Because if the answers to those questions are not known, and you're not at least somewhat successful at achieving those goals of being where and with who and doing what you want to be doing, then it won't really matter if you've got the best Social Security benefit or you were so efficient at rolling over your 403B, because you're going to be miserable in retirement. And retirement, ladies and gentlemen, on average is about 8,000 days. So think about, what are you going to do on your first day of retirement? Now think about, what are you going to do on your 5,000th day of retirement or your 8,000th day of retirement? And yes, in case you're not doing the math real quickly in your head, I happen to know 8,000 days is 22 and a half years, and that's the average length of retirement. So if you're going into retirement with a plan on kind of winging it, my suggestion to you is that probably won't work real well, because 22 and a half years is a long time. You need a plan. You're going to need to evaluate your retirement savings and determine if it's enough and what are the income sources that you're going to use. Social Security might be one of them. You might have a pension, other sources of income, investments. You're going to need to figure out what your expenses are, and you need to have a strategy so that your income exceeds your expenses. Otherwise, it's upside down, and that doesn't work so well. And one of the ways that you can be more effective at that is by optimizing your Social Security. When you take Social Security, depends on a number of different factors. And so to complement our opening of Social Security, let me introduce my colleague, Thad Ismart. Thad, I see you have your hand raised.
Not intentionally.
I'm going to lower your hand if I can.
I just wanted to make sure you were ready to hand it over to me.
In any event, so Thad is going to take over. I'm going to remind everybody to use the Q&A function, use the chat function, make this interactive. We've got a solid 45 minutes here to cover a lot of information. We'll go a little bit longer if we have to, but we'll try to get it done by 1 o'clock. Thad, it's all yours.
Thank you, Sandy. So as you can see, the 6 bullet points, these are just some of the things you need to think about when you are deciding when you should start your Social Security benefits. Your starting age, we'll talk about what that means on the next slide, but starting age will depend on your certain specific circumstances, whether you're about to retire or going to retire, but also could impact the amount that you receive from Social Security. If you start prior to your full retirement age, you're going to get a permanent reduction. If you start after your full retirement age, you're going to get a bonus, and that can be up to age 70. You'll get a bonus each year. We'll talk about what that means and what a full retirement age means. If you're working, that could affect the amount you receive. It could reduce your benefits further. Savings and investment, health and longevity, marital status. If you're married, you may want to delay your benefits, and I'll talk about why. Tax liabilities, and there's going to be taxes due on your Social Security benefits, and that's going to be dependent on one figure, and it's called your combined income, and I'll talk about what that means too. Go to this slide, talk about your full retirement age. Your full retirement age is simply the age at which you're eligible to receive your benefits, no bonus, no reduction. That's what you paid into the system, so that's what you're going to get. Your full retirement age depends on the year you were born. If you were born between 1943 and 54, full retirement age is 66. Full retirement age goes up 2 months each year you were born after that. So if you're born 1955, full retirement age is 66 and 2 months. All the way to 1960, you're born 1960 or later, your full retirement age is age 67. If you hear the word or the term PIA, or primary insurance amount, don't be scared or confused. All that is the full retirement age benefit. It's the benefit that you receive at your full retirement age. Primary insurance amount, full retirement age benefit, exact same thing. Go to the next slide. We can see the effects of starting your benefits prior to full retirement age and starting your benefits after your full retirement age. We're going to assume this person's full retirement age is that blue column in the middle, age 66. If they wait till age 66, their full retirement age benefit is $1,800. This is the amount that varies up or down depending on how soon you start your benefits or how late you start your benefits. If this person started their benefits at age 62, instead of $1,800 per month, they're going to receive $1,350 per month. If they delayed their benefits all the way to age 70, they'd receive $2,376 per month going forward instead of $1,800. The reason for this is that Social Security is going to penalize you if you start prior to your full retirement age. If your full retirement age is 66, the earliest you can start is age 62. You can start as early as age 60 if you're disabled in some other conditions, but for most people, age 62 is the earliest you can start. Full retirement age 66, that means you're going to receive a 25% reduction in your benefits. Once it's reduced, it will always be reduced. I'll talk about what that means too. Sounds self-explanatory, but there's some caveats that go with it that many people do not realize. And once you make a mistake, If you do make a mistake, you have 12 months to correct it. After that, you can't undo it. I'll talk about all of that. So this person can start at 62, reduction is 25%. They receive $13.50 per month. The reduction is a little bit less each year they delay all the way to age 66. There is no reduction. It doesn't stop there. They could start their benefits a year later. If they do, they're going to get an 8% permanent increase all the way to age 70. So if they wait till age 70, they would receive a permanent 32% increase in their benefits going forward. What does that mean? Well, the two bullet points on the right, the benefit at age 70, 76% higher than the age 62 benefit. But there's a trade-off. The trade-off means they're going to have to forego all of those benefits from age 62 until they start at age 70. That means they give up $129,600. In exchange, they get a higher benefit going forward. This tells us something. We'll go to the next slide, and then I'll tell you what it tells us. You may already be thinking about what it's telling us. Here, a little bit different, but this person's full retirement age, again, 66. Their full retirement age benefit is is 24,000. If they started at age 62, 25% reduction, their benefit's going to be 18,000 per month. Whereas if they waited till age 70, 32% increase permanently, they're going to get $31,680 per month. If they live to 70, starting at 62, total dollars received will be 144,000. If they started at age 66, of course, they're going to receive less dollars because they're receiving benefits for not as long. It's going to be 96,000. And then age 70, if they start at age 70 and then they pass away, assume they pass away at age 70, they're going to receive $0. If they live to age 80, age 62 benefits, total dollars received are 324,336, 316. You can see that age 80, they receive somewhere around the same amount of dollars. The reason for that is Social Security was designed so that no matter when you start your benefits, age 62, age 70, or anywhere in between, if you live to your life expectancy, you're going to receive the same amount of dollars over time. And the life expectancy, according to Social Security, is about age 82. So that's what you see on the live to 80 line, 324, 336, and 316. If you look at the live to 90 line, total dollars received, 504, 576, 633,000. The longer you live beyond your life expectancy, the more total dollars you'll receive over time if you start at age 70. So I say a joke, probably can't hear any laughs today. Hopefully there are some there, but if you tell me when you're going to pass away, I will tell you exactly when you should start Social Security so you maximize your dollars. We don't know that for the most part. So generally speaking, health and longevity, if that runs in your family, probably going to benefit, you see more dollars over time by starting later than earlier. Whereas if there are health issues, you may want to start prior to your full retirement age so that you can maximize your total dollars over your lifetime. Next, please. Timing your benefits. So there are some additional effects. Benefits before your full retirement age, they can be reduced by up to actually 30%. If your full retirement age is 66, you start at 62, reduction is 25%. But if your full retirement age is 67 and you start at 62, the reduction is 30%. If your full retirement age is somewhere between 66 and 67, then the reduction is going to be somewhere between 25 and 30%. Spousal benefits. When you apply for benefits, you actually can apply for benefits based on your spouse. It used to be that you could use a couple strategies, which I'll go through in a few slides, where you could apply for benefits, restricting it to spousal benefits while letting your own benefits grow, getting that 8% increase every year all the way to age 70. Now, you can't do that anymore. If you apply for benefits, you're going to be what's called deemed to be applying for all benefits you're eligible for. You will get the greater of your benefit if you're eligible, spousal benefits. If you wanted to start your spousal benefits, for example, let's assume that there's a spouse that does not work outside of the home, has not, therefore has little or no earnings history because they took care of the children, for whatever reason, they just worked inside the home and didn't have much of an earnings history. They may not have a retirement benefit. That person could start benefits based on a spouse if the other spouse started their benefits to receive spousal benefits. The earliest you can start would be age 62. You can start those spousal benefits, but you're only going to get 35% of the full retirement age benefit of your spouse. Waiting to your full retirement age allows you to receive a maximum of 50% of your full retirement age benefit of your spouse. So just know that spousal benefits aren't as relevant as they were before, but there are some scenarios where spousal benefits make sense. You can start it earlier, but there's a reduction that's 35% maximum. You can see at full retirement age would be 50% of those spousal benefits. You used to be able to file and suspend, use a file and suspend strategy. You had to wait until your full retirement age to do that. I have some examples I want to run through, and I think it's going to demonstrate why Sandy, as Sandy noted, Social Security, there's an uncertainty of whether or not it's going to be there. I'll talk about why it still will be there, may not be in the same form, but this will show you, demonstrate the reason, one of the many reasons why Social Security, or there's a concern that Social Security will be insolvent. And I don't think it should be. I think you'll come away with the same conclusion. Once you reach your full retirement age, can we go back real quick? Once we reach the full retirement age, there's no limitations on earned income. If you start your benefits prior to your full retirement age and you're still working, not only are you going to get a penalty for starting early, but you're also going to get a penalty because you're still working, meaning that they're going to maximize the amount of you can earn before Social Security is not reduced further. There's some thresholds. I'll talk about what that means. Once you reach your full retirement age, you can start receiving benefits, earn as much as you want. Your benefits will not be reduced because you are still working. Then after your full retirement age, there are those delayed retirement credits. Those are the bonuses you get, 8% increases permanently for the rest of your life. Next, please. So how do you calculate your Social Security payment? And it's important to note how this is done, just so as you go through the process of deciding when you want to retire. I've seen many times that clients say that they want to work an extra year to increase their Social Security benefit. That may or may not actually happen, and I'll show you why in the next few slides. First, you must work a minimum of 10 years or 40 quarters. You don't have to work consecutive quarters or consecutive years, just 10 years, 40 quarters over your lifetime. The formula uses the highest 35 of inflation indexed earnings. What that means is Social Security takes an index factor, cost of living adjustment, and applies it to your earnings history each year to adjust for inflation. And I'll talk about how you can calculate those, how you can find those to use in your calculation for your Social Security benefit. Everyone does not have the same inflation indexed earnings. They do not have the same index factor. They do not have the same bands, dollar bands used in the equation. On the next slide, you'll see the equation. Don't get overwhelmed. It's not as complicated as it looks. What this means, though, is each additional year up to 35 years will improve your earnings. If you've only worked 35 years and you have a zero and you haven't worked beyond that, you actually have 35 years of earnings history. It's just one of those years is a zero. Replacing that zero with any dollar amount will increase your Social Security. The greater than zero the amount is that you earn, the higher the increase, although it's going to be a marginal increase. And in the equation, you'll see why. Also, if you've worked 35 years, working an extra year may or may not increase your benefit. If it's not one of the highest 35 years, it won't increase your benefits. You're just working. Now, it's great if you enjoy it, you're earning money, but just know it may not increase your benefit at all. On the next slide, if you wanted to calculate your Social Security, this is how you can do it. Here we have 1968, 1969 earning history. I took out a couple years. I threw in 2020 through 2022. Column A is the maximum you can earn in the respective years on which Social Security taxes apply. Meaning in 1968, if you earn $6,601, $6,600 will have the Social Security tax applied. That extra dollar above $6,600 will not have the Social Security tax applied. Column B is the actual earnings for that year. Column C is the index factor for that specific year. Social Security every year is going to assign index factors for each year that you have earnings, and everybody has the same index factor if you were born in the same year. In other words, if the first year that you're eligible for Social Security, age 62, whenever you turn age 62, everyone that turns 62 in that year has the same index factor. So if you turn 62 in 2022, you have a set of index factors. They're reassigned, re-upped every year. But if you turn 62 in 2021, you have a different set of index factors than the person who turns age 62 this year. So you need to find the year that you turn age 62 and then find the index factors associated with that year. These numbers are updated every year. Use those numbers in the equation below. Along with the index factors, if you find them associated with the year you turn 62, you'll also find the bands. The bands are band 1, band 2, and band 3. And that's the $896. So each year, like the index factors, are going to have 896, could be more, could be less, depending on your year that you turn 62. What doesn't change is the percentages, the 0.9. So in this example, we have the index factors. Column D is a product of column B and column C. And then under that, with 2.5 million, to make my life easier in the math, we're going to assume that the highest 35 years of this person's inflation indexed earnings history is 2.5 million. That's the number we're going to use. We take the 2.5 million, we divide it by 420. It's the number of months in 35 years. And then we take the band that was assigned for this person's birth year they turned 62, take 896 and multiply it by 0.9. We get a number, $806.40. And then we take the next $4,084, that's the second band specific to this person's age 62 birthday year. We multiply it by 0.321 or 32.1%, we get another number. And then band 3 is anything above 4,984. That's the third band specific to this person's age 62 birth year. We multiply that by 15% and we get another number. And then we add all of that together and we get 2,257. It would be great if we could just take 2.5 million divided by 420 and get 5,952, but that's not how Social Security works. They use this formula so the folks who earn more than others don't get a higher benefit, relatively speaking, than someone than the folks who don't earn as much. And that's what's happening here. I'll run through an example, talk about an example of a client who came to us a few years ago. She came in and we were reviewing her investments, her financial plan, talked about her current situation. She said she wanted to continue working and we asked her why. She was about to retire. I think she was 67, 68, close to 70. And she said she wanted to increase her Social Security benefit to make sure that it was a larger amount and was there for her because it's a cost of living adjusted kind of like a pension. It was like a security blanket. She wanted to make it increase it as much as possible. And she had a Social Security statement and her earnings history. And I asked for it, and she was talking with another one of my colleagues about her investments and chit-chatting about other things. And it took me a few minutes, and I calculated her Social Security benefit and asked about her new salary, and I plugged that in. And while it would increase her Social Security benefit, it would only increase it by about 12 to 15 cents per month. And the reason for that is, while it replaced one of her highest 35 years of indexed earnings, it only was, I'm making it up, but maybe $100 or $200 more after adjusted for inflation than the lowest earnings, lowest earnings record she had, the lowest 35 years. And then so if it was only $100 more, well, the $100 more is added, is multiplied. It's that marginal rate, 0.15. So you have to multiply it by 0.15 and then divide it by 420. If you take 100 and divide it by 0.15 and divide it by 420, you're going to get 10 cents, something like that. That's the reason. So just know if you're working beyond your, or after 35 years, if it's not significantly higher than one of the lowest years, it's not going to increase your Social Security benefit that significantly. You can certainly calculate it. Social Security recalculates it every year as you go through. It replaces one of the lowest years if it is, and it gives you your new benefit.
And Thad, quickly, two questions. One, a little bit of confusion about the file and suspend. And somebody's asking, they thought that was done away with the Trump tax legislation. So if you could just add a little bit of clarity. I know file and suspend can be confusing for folks. And then also on this chart that we're looking at right here, there's a question about how do you know what the band numbers are for your retirement year?
Social Security has that listed on their website. So when you go find your factors, because if you're born in, I'm just making it up again, but let's say you're 62 in 2020. So 2020, you find that year, find the index factors associated with that year. Along with that, they give you the bands that you use. You plug in the 896, you plug in the 4,084 and the 4,984, you'll get the numbers. So that's how you can find them. And they redo those every year. So those are changed or adjusted for inflation by Social Security. You can just look them up, and it's based on the year you turn 62. The file and suspend strategy, yes, it has gone away. The reason why I mention it is it's still relevant, although as we progress, as we get older, it's less and less relevant. You cannot file and suspend anymore. You can't use that strategy, but someone could have used it a while ago, and it's still in here. And I'd like to use it because probably in a few years, maybe even next year, it'll be irrelevant. But it's good to show you why there's a question of Social Security and why it's going to be running out of money. And so that's why I keep it in here. Yes, it's gone, can't use it. You can still use the restricted application, but again, you have to have been 66 by 2019, I think it was 2020. We'll talk about some examples in a few slides and run through those. And if there's questions, we can always follow up with that. So I did mention that working can affect your benefits. And this is common when we did this presentation in person, more often than not, at least once a seminar, someone would come up to me and say that they wanted to start their Social Security prior to the full retirement age. And I would ask if they're still working. And they say, yes. I said, well, realize that your benefits are going to be further reduced if you're working while you receive your benefits, and they're not aware of that. It's going to happen if you start receiving benefits prior to full retirement age. Social Security is going to ask you if you're going to earn any money this year. They're going to say how much you're going to make. You're going to have to estimate it. If you overestimate, then they're going to give you some dollars back at the end of the year. If you underestimate what you tell them, then you're going to owe some money. They're going to reduce your Social Security benefit until the reduction is met. The reduction is $1 for every $2 above a limit of $19,560 in 2022. That amount goes up with inflation every year. Currently, it's $19,560. So in this example, if you start your benefits prior to full retirement age and you go to Social Security and say, I want to start my benefits, they're going to ask you to estimate what you're going to earn this year because they don't know. They need you to do that for them. If you say, in this example, $29,560, that's $10,000 above the threshold, they're going to withhold $1 for every $2 on the amount above that threshold, 1 for every 2 on 10,000. That's a $5,000 reduction. So starting your benefits early is going to give you the early starting penalty, and then they're going to reduce your benefits by $5,000, meaning they're not going to send you a single paycheck until that $5,000 is met. So if your benefit is $2,000, they won't give you the first paycheck, they won't give you the second paycheck, they'll give you half of the third paycheck, and then you'll start receiving benefits. If you overestimate, you'll get some money back. If you underestimate, they'll withhold more until that reduction again is met. Now, it's important to note that if you do start prior to full retirement age, once you stop working, and I still don't understand why they do this, but they will give you all of those withholding dollars back in a lump sum. Then it will be as if you started your benefits at that time, rather than at age 62, for example, age 63. It'll be when you stop working, but you still have the early starting penalty. So if you're going to reduce your benefits because you're working, I would suggest not receiving those benefits just because you're going to get that early starting penalty. That's not to say you shouldn't. If you need the money and they still withhold some, well, you have extra money coming in, you will get it back in a lump sum in the end when you do stop working. Once you reach the year of your full retirement age, the reduction is less. It's $1 for every $3 above a higher limit. Same rules apply, but the reduction is less. Once you reach your full retirement age, you can work as much as you want. There's no penalty for working. You can earn $1 million a year and your Social Security benefits will not be reduced. If you decide to start your benefits for whatever reason and you make a mistake, it doesn't have to be at full retirement age or prior. If you start at 62 because you're retired, and then, well, I'll give you an example. We had a client, he started receiving their benefits in 2020, January 2020, and then the pandemic hit. Well, he realized that he didn't have to go into work, but he could still work from home, and there wasn't a commute. He didn't have to deal with any of the whatever he was going through, where he could stay at home and it was easy for him. So he stopped. He undid his Social Security benefits. So in April, May 2020, contacted Social Security and said, I want to undo it. Now, he had to repay any benefits received up to that point, including any taxes that were withheld. So if you start your benefits, you have taxes withheld going to the federal government, then you have to repay those taxes back if you want to do it. And then in turn, you'll just get a refund because you won't owe as much tax when you file your taxes. So just know you have 12 months to undo any decision, and it doesn't have to be prior to full retirement age. If you start your benefits at full retirement age, you have 12 months to undo it. So if you did make a mistake, you can repay all of those benefits. And then it'll be as if you haven't started benefits, and then you can receive even delayed retirement credits if you wanted to. Next, please. Restricted application and file suspend. The restricted application, it was phased out. So if you were born after January 2nd, 1954, 2020, you cannot use the restricted application at all. If you were born before January 1st, 2020, you can still use the restricted application. And so if they were born in 2066, so you could be 68 now, you can still use the strategy. You just can't use it if you're born after that. The file and suspend strategy, that was completely phased out. There wasn't any grandfathering in. It was, you can't do it. You had until April 30th, 2016, if you were born before May 1st, 1950 to do it. You can't do it anymore. So I keep this in here, one, because it kind of tells a story of what's happening to Social Security over time. the insolvency, but also too, because it could be, for at least for the next 2 years, someone could still use the restricted application strategy, but only for a couple more years. After that, they're going to be 70 and there's no reason to use it anymore. So for at least a couple more years, we'll probably keep this in here. Maybe for historical reasons too, depending on how Social Security changes. So the next few slides we'll go through an example of what some could have done and potentially someone can do if you're eligible still for that restricted application. In this example, we have 2 spouses. We're going to assume both spouses are the same age. And we're going to assume one spouse did not work outside of the home. So one spouse was the breadwinner. The other one did not work outside of the home, raising children, whatever the case may be. They just didn't have a significant earnings history with little or no benefit. And we're going to assume this first spouse passes away. And I'm sorry for spouse 1, but in all 3 examples, spouse 1 passes away at age 80. Age 66, spouse 1 is going to file for benefits and immediately suspends them. So spouse 1 goes to Social Security and says, I want to file for my benefits, but wait, I want to suspend them. Social Security is going to say, you don't want to receive them? Of course, spouse 1 says, no, I do not. The reason for that is once spouse 1 either files for benefits, their own benefits, or uses that file and suspend strategy, that triggers the ability for a spouse 2 to file for spousal benefits. In order for a spouse to file for spousal benefits, the other spouse has to have either filed or filed and suspended. So in this case, and reached full retirement age. So in this case, spouse 1 files for benefits, but they're only doing that because they want their spouse 2, to receive spousal benefits. This will also allow spouse 1's benefit to grow by 8% per year. Spouse 2 then starts receiving spousal benefits, which is a maximum at their full retirement age of 50% of their full retirement age benefit. Spouse 2 is receiving half of the full retirement age benefit of $2,500. So they're going to receive $1,250 per month. So for both of their ages 66 to 70, they're going to receive $1,250 per month. At age 70, spouse 1 begins their benefits. Remember, spouse 1 applied for benefits but immediately suspended them, and this allowed spouse 1's benefits to grow by 8%. At age 70, spouse 1's benefit is now $3,400 per month. So total, they're receiving Social Security benefits of $3,400 plus $1,250 per month, or $4,650 per month. At age 80, or spouse 1 passes away. When a spouse passes away, the surviving spouse is eligible to receive the greater of their own benefits or the deceased spouse's benefits, even if they weren't receiving it yet. Spouse 2 was receiving at age 70, $3,400. So spouse 1 was receiving $3,400. So spouse 2, when spouse 1 passes away, spouse 2 can receive the greater of $3,400 or half of spouse 1's full retirement age benefit, which of course is $3,400 is the greater amount. So spouse 2 is now eligible to receive the $3,400. That replaces the spousal benefits. Spouse 2 gets that for the rest of their life. Typically, it's best for the higher wage earner to wait as long as possible to receive their benefits, because it ensures that higher amount will be there for both lifetimes. In some cases, it doesn't make sense. Case would be if there's a married couple and the higher wage earner is significantly younger than the other spouse. Well, it doesn't really make much sense to wait as long as possible, because you don't need to ensure that your benefit is there, or the spouse 1's benefit is there for spouse 2, because statistically spouse 2 will probably pass away before spouse 1, something like that. But for the most part, higher wage earners should wait as long as possible. Again, that's just a generality. Your specific circumstances, of course, would dictate when you should start. But in this example, that's what's happening here. Spouse 1, higher wage earner, waited till age 70, so that ensures that higher amounts there for both spouses. On the next slide, we are going to talk about the filed or the restricted application strategy. Third slide, we're going to put these 2 slides together. Same example, except this time spouse 2 has a benefit. Spouse 2's benefit is $1,500. Everything else is the same, except what strategies they use. So this time, spouse 2 takes their own benefit. They start receiving their own benefit, $1,500 per month. This triggers the ability of spouse 1 to receive spousal benefits. In order to receive spousal benefits, remember, the other spouse has to file for benefits and receiving them, or use the file and suspend strategy. They didn't do the file and suspend strategy in this scenario. Spouse 2 just starting their own benefits. This triggers the ability for spouse 1 to be eligible for spousal benefits, and they're going to use, as in the first example, they're going to use that restricted application. So spouse 2 is eligible to receive half of spouse spouse one's eligible to receive half of spouse two's full retirement age benefit, which is $750. So from age 66 to 70, in this example, they're maximizing their dollars from 66 to 70. They're going to receive $22.50 per month. At age 70, spouse one then switches over to their own higher benefit. Just as in the file and suspend strategy, restricted application allows you to apply for benefits, restrict it to spousal benefits, and also receive those 8% increases per year. Spouse one's benefit, same as the previous slide, is also $3,400 per month. And also, as in the previous slide, at age 80, spouse one passes away again. The spouse two is eligible to receive, this time, the greater of their own benefit, $1,500 or $3,400. Of course, $3,400 is greater, so now spouse two again can receive $3,400 for the rest of their lives. The next slide, we combine them together, and this is how this couple can maximize their benefits. And this is one of the reasons why Social Security was becoming insolvent, because it wasn't intended to work this way. And I'll talk about what I mean by that in a second. Same example, except this time spouse one files and suspends their own benefit, as in scenario one. Spouse two then files a restricted application and receives spousal benefits. Remember, in the first scenario, spouse one did not have an earnings history. They did not work outside of the home. Spouse two didn't. So spouse two this time does. Instead of applying for spousal benefits, they still receive spousal benefits, but they apply for benefits, restricting it to spousal benefits, so they can receive an 8% increase, as in scenario two. Spouse one and spouse two then switch over to both higher benefits, $54.40 per month to get combined. And then again at age 80, spouse one passes away. Spouse two is eligible to receive the greater of their own, $2,040, or the deceased spouse's benefit, $3,400. And again, that includes those delayed retirement credits. Let's assume spouse one passed away at age 70. Even if they haven't started their own benefits, if they were eligible to receive $3,400, but they haven't gone to Social Security yet because of timing and it was an unfortunate accident, for example, spouse two is still eligible to receive that benefit. Spouse two, the surviving spouse, is eligible to receive any benefit that the deceased spouse was receiving or eligible to receive. It's a common question. So they don't have to start their benefits. Even if they haven't started, they can still receive those benefits of that's a higher amount. Next, please. More on survivor benefits. You can start benefits as a surviving spouse as early as age 60. Remember, retirement benefits as early as age 60. Survivor benefits based on a deceased spouse, you're eligible to receive those as early as age 60. If you're disabled, you can start them actually at 50, whereas retirement benefits is 60. So a little bit different ages. And it's important to note that survivor benefits are not subject, and I guess they would make this change sometime, although I've been saying it for a few years. Survivor benefits are not subject to the rule of the restricted application being phased out. Remember that when you apply for benefits now, you're going to be deemed to be applying for all benefits you're eligible for. You're going to get the greater of your own benefit or survivor or spousal benefits if your spouse has started receiving your benefits. You're going to get the greater of those two. However, if you are a widow or widower, you have a deceased spouse, you can start your benefits at age 60. It's going to be reduced because you're starting prior to your full retirement age, but it will not affect your own benefits. You can even delay your benefits to age 70 and start them at that point and get those 8% delayed retirement credits. So just know that survivor benefits based on a deceased spouse, are not subject to any of the changes in the laws. You can still apply for these benefits. You don't have to use a strategy. You just apply for survivor benefits. And then whenever you're ready, you switch over to your own benefits. And this also applies to a benefits based on a deceased ex-spouse. Different rules for ex-spouses. You're still eligible for spousal benefits, but once the ex-spouse passes away, you're eligible for benefits based on a deceased ex-spouse. However, if you were remarried, then you are not eligible, remarried, I should say, before age 60, you are not eligible for benefits based on a deceased ex-spouse. If your ex-spouse passes away, or even if it's a spouse passes away, it doesn't have to be an ex-spouse, but if your spouse passes away or ex-spouse passes away, if you get remarried, you're not eligible before age 60, you're not eligible for benefits based on a deceased spouse. If you get remarried at age 61 or later, you can still apply for benefits based on a deceased spouse. Next, please. You can receive up to 100% of your deceased spouse's primary insurance amount. That's the full retirement age benefit. if survivor benefits are received no earlier than your full retirement age. All that means is that if you receive benefits prior to full retirement age, then you are not going to receive the maximum amount of benefits. You're not going to get the full retirement age benefit. If you wait till your full retirement age, then start receiving benefits based on a deceased spouse, you'll get the full benefit. Below that is the reason why. Social Security is going to be subjecting you to a new penalty if you start your benefits early. The maximum a survivor can receive based on a deceased spouse who started their benefits prior to full retirement age is 82.5% of the full retirement age benefit. I know that's a mouthful. Let's run through an example. I think you'll get the idea. Let's assume there's a married couple and the full retirement age benefit of spouse one is $2,000. Spouse two or spouse one started their benefits at age 62, full retirement age is 66, 25% reduction. So they're going to start receiving $1,500 next month. But unfortunately, spouse one passes away because they get hit by a bus the next day. Never started receiving their benefits, but now spouse two wants to start receiving their benefits. And who's also 62, they can start receiving their benefits at age 62. It's going to be a reduction from the full retirement age benefit of $2,000. Typically, if spouse one had not started their benefits early, the longer spouse two waits up to their full retirement age of 66, the benefit will slowly increase to meet that $2,000. But because spouse one started early, the longer spouse two waits till their age 66, eventually it's going to get capped at 82.5% of 2,000. So somewhere around 63, 64 age, that benefit's not going to ever get any further closer to 2,000. It's going to be capped at 82.5% of 2,000, which is $1,650. So starting your benefits early starting penalty, potential problem with working. If you are working prior to full retirement age, they're going to reduce your monthly check until you stop working. And then you're going to subject your spouse to that widow's cap. A maximum they can receive of benefits based on your record is going to be 82.5% of $2,000. So just know there's 3 penalties potentially for starting your benefits early. Next, please. For divorcees, just like spousal benefits, you can get benefits based on an ex-spouse. And just in case I forget, it's important to note that 85% of people eligible for benefits on from a deceased spouse, ex-spouse, or an ex-deceased spouse, deceased ex-spouse, do not receive them. And the only reason is because they are not aware that they're eligible for them. So just know that whether it's now or in the future, if you have a deceased spouse, an ex-spouse, or a deceased ex-spouse, you could be eligible for some benefits. In order to qualify for benefits based on an ex-spouse, you just have to have been married for 10 years or longer, can't be currently married, and you have to be age 62 or older. If you meet these criteria, you're eligible for benefits based on your ex-spouse. Same rules apply as if you were married. Maximum you can receive is 50% of your ex-spouse's benefits. In order to receive them, ex-spouse has to have started receiving their benefits. Except on the next slide, as long as you've been married as long as you have been divorced 2 years or longer, you can start receiving benefits based on your ex-spouse without your spouse having to do anything. They don't have to be receiving their own benefits, and it won't affect their benefits. Even if they were remarried, it will not affect their benefits based on their new spouse. They'll actually never know that you even started your benefits based on their record, excuse me. But keep in mind, the same rules apply. If you're applying for benefits based on an ex-spouse, spousal benefits, you're going to be deemed to be applying for all benefits you're eligible for. So when you apply for benefits, they're going to look at the grader of any benefits you're eligible for, your own benefit, or 50% of your ex-spouse's benefits. You're going to get the grader of them. If your ex-spouse passes away, whenever that is, you can start using the same technique I talked about before on survivor benefits. You can start benefits based on a deceased ex-spouse, never touch your own benefit, let your own benefit grow by 8%, then switch over to your higher benefit at age 70. So even if your ex-spouse hasn't passed away yet, there are benefits eligible for it without sounding too morbid. There are things you can do, wait for, to increase your benefit if it is even possible. Even if they wait to receive their own benefit till age 70, you could switch over to the higher benefit too, as early as age 60, and then switch over to your own benefit. So there are still some strategies you can use. Will your benefit be taxable? Most likely, yes. The combined income figure that I talked about, combined income is defined as your adjusted gross income plus half of your Social Security benefit plus non-taxable interest. That's your combined income. If that number falls between 25 and 34,000, you're a single tax filer. 50%, up to 50% will be taxable. That means 50% tax-free on the federal level. You don't have to pay taxes on it. 50% will be taxed at your marginal tax rate. If you're married, the window is 32 threshold, I should say, 32 between 32 and 44,000. If you combined income, if your combined income is over 34,000, single tax filer, 85% is going to be taxed at your income tax rate, 15% tax-free up to. Over 44,000, married filing jointly, same thing, 85%. If your income, combined income is less than 25 and 32,000, Social Security benefits are not taxed on the federal level. Sandy.
I had a question about taxes, and this person is just curious that let's assume they start collecting their Social Security benefits before their full retirement age. It appears from this example that they're not working. They are receiving some IRA distributions, maybe a small pension. Are those payouts considered income since they're not from an employer? How is that taxed?
It is, unfortunately. And this is your adjusted gross income. It's, well, two things. If we're talking about the earnings test, meaning benefits reduced $1 for every $2, $1 for every $3, those are not counted as earnings. Those are distributions. For the taxability of Social Security purposes, those distributions are included in your adjusted gross income. So your adjusted gross income sums up all of your income, and then there's any above line deductions. Above line deductions are things that aren't subtracted from your adjusted gross income, but that are subtracted from gross income. For example, pre-tax contributions to a thrift savings plan, 401k, 403b, those are subtracted. Then you have your income, and then you have your distributions, pension, Social Security, your adjusted gross income, that's included in that. So depends on what we're talking about. If you're talking about what's income for the earnings test reduction, IRA distributions are not included. Those are not wages. This could be self-employment income, 1099 income, W-2s from employers, or if you're self-employed. IRA distributions for this purpose, taxability of Social Security, is included in adjusted gross income. What's not included, though, good point, is Roth IRA distributions. Now, we would suggest Roth IRAs or Roth accounts should be the last place you touch money, last place you withdraw money from anyway. So we wouldn't want you to take typically from those accounts. But Roth distributions are not included in adjusted gross income. So if you wanted to, you could fund your retirement partially from Roth accounts. You could have zero adjusted gross income. If you add in your half your Social Security benefit, that could be below the 25 or 32,000. You could have tax-free Social Security. You're giving up, though, the growth of the Roth accounts, but I wanted to mention that. That was worth mentioning.
Right. So we're knocking up against 1 o'clock here. I know we've got 1 or 2 slides left. A quick question, and then we'll go on to the next slide. If you do not have a spouse, are children entitled to that benefit?
That's a good question too. Yes and no. There is no survivor benefit for adult children. There is survivor benefits for minor children. So if you have a minor child, you pass away, there is a Social Security benefit that they would receive. Because minor children can't hold property, they are going to have to get a representative payee account, which is an approved account by Social Security that is guaranteed, that has some interest rate. So that's another topic. But if you have minor children, you pass away, they get a benefit. If they are adult children, they do not get a benefit. And also, it's important to note, if you have minor children and you start receiving your own Social Security benefits, they are going to get a similar amount as well. It's going to be a little bit less, but you basically get almost a double payment if you have minor children when you start Social Security benefits. So if you're age 67, 66, full retirement age, you start your benefits, you have a minor child who's 18 or younger, it might even be 19 if you're in college, you're going to get another payment because they need to help pay for the minor child too. So that's another reason to start your benefits prior to your full retirement age or prior to age 70, especially if you have minor children, because you're going to get a double payment until they turn 18. So you may decide to take your benefits earlier if you have a minor child. It's not up there, but we should add that. If you have a minor child, you may want to start because it helps pay for the expenses. Now, you start receiving that double payment, but that double payment ends once the child reaches 18. So over time, longer you live, you still receive more benefits. You wait till 70, but that could be a reason because it helps pay some of the bills, especially if you're a single parent. If you need Social Security income right away, some of our clients want to invest their money. I would caution against this because I've seen it happen where clients and other people start receiving Social Security thinking, okay, well, I'm going to invest it. I think I can earn more than the increases that I receive. But what happens is it's an income stream coming in, and then they stop investing it. Then they start spending it, which is fine. But if they don't need it, they would have been better off keeping it where it is to get the guaranteed increases. So some clients, some people think they can invest it. It's great. Some people take it early because it helps pay for college or grandchildren's college, or helps pay for a mortgage on a vacation home. So that's a need. That could be a need why you want to start early. If you want to delay from taking from other accounts, if there's a significant decline in your investments, you don't want to be forced to sell when your nest egg is down in value. That's a reason to start Social Security. Give it some time to recoup the value. Let it go back up, like a V-shaped recovery. Spouse wants to delay taking their benefits, you can start your benefits. Or if you wanted to delay your benefits, you get that higher monthly amount. Keep in mind, when you delay your benefits, as you know, as we talked about, you get that 8% permanent increase. But then every year there's a cost of living adjustment. Cost of living adjustment for a higher number is always going to be a higher number. For example, if your benefit is $3,000, cost of living adjustment is going to be a percentage. It's going to be 6%. 6% of $3,000, 180. If your benefit is $2,000, same 6% increase, it's only going to be $120. Whereas, and so there's a snowball effect because it keeps getting a higher amount, and the percentage or the increase is always going to be a percentage, and a percentage of a higher number is always a higher number. So that's how you can snowball your Social Security benefit over time. Maximize survivor's income. We talked about that. If you plan to work longer, if there's no need to take it financially, delay. Don't start receiving your benefits. Or if you could file for spousal benefits first and then switch to your own benefit, that's if the restricted application. We only have a couple more years before nobody can do it at all, because that person would have been 70 and they would have started their benefits already. So choice is yours. Again, I say if there's no need, don't take it. But that need doesn't have to be financial. It could be one of the many things we talked about. Could be even that you're worried that Social Security is not going to be there, and you want to make sure that you receive some benefit while you're alive because you've been paying all these years. I get that. Financially, doesn't make much sense, but if it helps you knowing that you got some of those benefits and it doesn't impact negatively on your retirement, then that's a reason to start your benefits.
And I think, that last sentence that Thad just said is so important, which is there are always choices. Some decisions are better than others, but the key is there no negative impact? Because there are some decisions that you can make that the wrong decision really does have a fairly significantly negative impact to your overall situation. So you want to avoid that. Again, while some decisions are better, the key is, hey, this is what I want to do. Is this going to hurt me if I do that? It might not be quite as efficient as if you did it this way, but if you want to do it that way, it doesn't hurt you. We're fine with that. And that's what we often do, are giving people an opinion. So I know that we went a full hour, and I really appreciate all of you sticking with us. We do have a little bit of time before 1:15. I probably won't keep you all for a whole nother 10 minutes, but if anybody wants to ask a question, we'll be happy to take it. And I think we do have one here. How far in advance of your desired start date to begin receiving Social Security payments should you apply?
I'd apply a few months before you want them to start. Depending on your birthday of the in the month, it may start in the beginning, middle, or the end. So I'd go to them 3 months prior and say, and this is when I want them. They'll ask you when you wanted to start. What I wouldn't want you to have happen is go there this month, so it starts in September 1st. Probably not going to happen. So if you wanted to start in December, probably want to go there no later than September, October, just to make sure it starts when you want to. Now, there's no reason, if you miss it, for example, if you wanted to wait until age 70, you don't have to worry so much about starting it on your 70th birthday. If it's delayed beyond your 70th birthday, they'll give you retroactive payments so that you get the right amount of money. So it won't be as if you started and missed out. If anything, it would be you started prior to when you wanted to start, you either got a penalty or you didn't get the greatest increase that you could. So go there 3 months, they'll ask you when you wanted to start, and then they'll do that for you.
I would remind everybody too that if you're welcome to Sandra, who asked that question. Thank you. Appreciate your compliment. I would just remind everybody, I know this was a lot of information, and if you are looking for a replay, if you will, of this, we have on our website right now at bwfa.com this virtually the same webinar. Thad and I give this webinar about 4 to 6 times a year, maybe even a little bit more. And we have recorded it in the past, and it is posted on our website, bwfa.com. And so if there was some segment of it that you wanted to go back and watch again, or you thought somebody else would benefit from seeing it, just have them go to our website. It's there. I have a quick question here. I have several zeros in my yearly totals. How does this affect my Social Security? So we did cover this topic. I'm just going to give you a quick answer, and Thad can comment as well. But the way it's going to affect you is that if any of your years have no earnings, they're still going to use that year for the calculation. But instead of having a dollar figure in there, it's going to have a 0. So it's going to lower your benefit.
That is correct, except let's assume that maybe you have 35 years of history, and all 35 years you have some sort of earnings. Maybe, but it doesn't matter as long as it's greater than 0. If the zeros are not in those 35 years, it will not affect it.
Yeah,
but if you have,
according to this, several years will have a 0.
Right. So if you have several zeros, but you know, if you started working at age 22, you've worked 40 years. Maybe you're in grad school, you have 4 years of earnings history, but you have 40 years of actual earnings. Even though you have zeros in a couple of years, it's not one of the highest 35, so it won't affect it. But if you've only worked 33 or less years that has actual earnings, well, they're going to use the highest 35. And 2 of those zeros are going to be higher than 35. So hope that
for the person inquiring about our company services, yes, we do estate planning. And we do as well help our clients facilitate revocable trusts and other things of that nature. And really didn't want to get into a big commercial about us, but if any of those things or many other areas of wealth management are something you're looking for help for, please, by all means, you can go to our website. There's a schedule a consultation button right on the front page, and just let us know. We don't charge for that. You're not obligated. We can have a brief telephone conversation. We can have a Zoom meeting. We can have an in-person meeting, see what's on your mind, what you're trying to accomplish, and how we can be of help. All right, we'll take one more question here. What happens if I worked in another state, like Washington, D.C., for 7 years before working in Maryland? I see 0 in those years. I think you need to check with Social Security, probably.
Probably, but so let's assume that there was an earnings history in those years and you paid Social Security taxes. That's important. If you did pay Social Security taxes, you need to go to Social Security website, ssa.gov. There's My Social Security. You'll need to create an account if you haven't. And then if there's a dispute, you can start the process of disputing earnings history. You'll need to gather all the documents. It's going to be difficult. And this is common, especially for older folks, because 80s, 70s, 60s, a lot of these Social Security records were done strictly by paper. Paper is easy to get lost. It's not electronic. So you need to correct those and find records showing that you had the earnings and you paid Social Security tax. However, if you didn't pay Social Security tax, then it's not going to show up on your Social Security earnings history. That's only if you paid Social Security tax. For example, the CSRS, if you're a CSRS employee, Civil Service Retirement System, most of people aren't anymore. Those folks never paid Social Security tax. So if you had wages in those years and you didn't pay Social Security tax, that does not apply over to Social Security benefits. Similar to railroad benefits and postal workers, and some states governments don't pay Social Security tax. So it really depends on if you paid Social Security tax in those years that you had earnings. If you did, then you need to find the records and go to socialsecurity.gov, My Social Security, create an account, prove that you had earnings, and update it.
Good advice.
Now, also, real quick, you may not want to do all that work, especially if you can calculate using those bands. If it wasn't highest 35 years, it may not matter anyway, because you've already had 35 years of earnings and those don't count. If they were significant, that's when you want to do all the work. So keep that in mind.
Good point. Good point. Well, folks, my clock says 1:10, and I really appreciate all of you sticking with us for a solid hour, maybe even a little bit more. I appreciate the platitudes coming in. I'm glad that you found it helpful. And again, we're a resource here for you. Look for us at bwfa.com. Look for us at the Johns Hopkins Federal Credit Union website. Happy to help you in any way that we can. I wish you a healthy and safe balance of the summer. Thanks again for your time today. Be well.